Hey there, folks. Hey there, folks. This is Michael. Hi there, folks. This is Michael from Living and Create out of the back. As you can see from the hair, rather windy Bristol today. Gloucester Road, which is a place of small shopkeepers, and they, like you, if you run your own business, or indeed if you're just working as a freelancer or own property, and I've done all three in the past, and I try to do to some degree all three now. You may have the feeling I'm working really hard, I'm making revenue, i.e. sales, income, whichever way you want to use for it. But then there's a little money left in my account after this. And this is an incredibly important question because obviously one of the primary reasons we work in some form or other, or run a business or own a business, is to get paid personally in cash. In the end, property or a business is only worth the value that it has on paper if you can convert that to cash by selling it, or you own it for cash. So it comes down to cash. How come you got so little of it? Well, it's a great question. To really answer that question, of course, you've got to detailed deep dive into your finances, and you should. It's never a fun thing to discover that, but at least you know there's a problem to solve. I've recently been running some numbers for a couple of my businesses, or if you want to call it businesses, income streams. One is for rental properties, one particular property I rent out of our sort of mini portfolio that we have, and the other one is for some consulting work. In both cases, I can see that spending a far too higher percentage relative to what I want of the revenue making other people money. So some of those are more changeable than others. We probably ought to talk about this in a bit more detail in a couple of different podcasts to dig into the heart of the matter. But I would just flag up the 2 or 3 main ways you are probably spending money. The biggest expense that we've got to probably deal with is taxes. So that's everyone's always thinking about operating profit, or EBITDA, earnings before interest, tax, depreciation, and amortization. That's probably a big mistake. Obviously, you've got to make operating profit before it gets taxed, but the famous phrase from a lot of wealth creation experts, and I think they're right, is that tax is your biggest single expense in your life. So, for example, if you own and operate a small residential property business as a sole trader, that is to say, you don't have a company structure, which is what I currently do, for better or for worse. We've looked into how to change it, by the way, but that's the situation. Well, you're going to get hit with a lot of tax these days. If you're paying a lot of, rephrase that, sorry, brain not working today, you will find that the government doesn't take any account in the UK right now of any interest costs. So you get your operating profit. Say, for example, you rent out a house for £15,000 a year, whatever that is, $18,000 now, 20,000. Also, so you have to pay a managing agent, etc. You might get 50% of that money as operating profit, but then you're going to have to probably pay, in most cases, you'll have a mortgage, you'll have to pay interest on that. Now, the capital repayments is a separate thing, but if we're talking about profit and loss only, then you've got to pay interest. Guess what? You can't offset that against tax. So whatever money you make, maybe that's 50% of your £15,000 for the house. I've just used that figure because that's one of the properties we've got rent out for that figure roughly. Then you're going to pay tax on all of that 50% roughly, right? There are some nuances, and you should use a good accountant, in my opinion. But if you're paying tax, it depends on your tax rate, somewhere between 20 and 50% of your money, let's say, it ends up being 30%, just to make the maths easy. Well, that's 2,400 in tax. So after your tax, you're going to be making what, 5,400 in that opinion. That example, if I put my maths right, which is very, very roughly, you're going to make about a third of your income in profits. Now, that's probably sounds better than it really is, because that's obviously profit. You've then actually got to repay
any capital on the loan as well, and that's going to hit your cash flow. So typically, if you're going to pay it off over 20 years, depends on the size of the mortgage, that could be a lot of things. But let's say you're actually going to have to pay interest as well. So let's say you can buy the two, and that's £500 a month times 12, which would be £6,000. So actually, you'd be at a loss in that situation. So broadly, you make no cash, even though you are